Welcome back to IQT Insider, the channel where we separate sensational rumors from hard economic data. Today is July 1st, 2026, and a massive wave of excitement is sweeping across the currency community due to rumors of an internal banking memo regarding systemic changes. Internet forums and social media groups are flooded with claims that this document is absolute confirmation of an overnight revaluation. Many sources allege that financial institutions have been explicitly instructed to prepare for an immediate catastrophic shift in the exchange rate. This narrative has created intense urgency among investors, but we must step back and analyze what is truly happening. We are going to look closely at the realistic operational framework of global banking to explain how institutional protocols actually manage sovereign currencies. By staying until the very end of this breakdown, you will understand exactly how to interpret these developments without falling victim to emotional panic. The primary rumor circulating right now centers on a leaked document that supposedly prevents major financial institutions from denying upcoming structural modifications. Speculators assert that this text contains a specific countdown sequence leading directly to a multi-currency revaluation window. This concept of a secret administrative deadline is heavily utilized to prompt quick emotional purchasing decisions within speculative groups. However, international banking networks do not operate on hidden non-public operational directives for retail wealth redistribution. Any legitimate documentation in discussing internal adjustments is fundamentally focused on standard compliance protocols, cross-border transactional routing, and regulatory updates. Large institutions constantly distribute internal lucices to keep compliance officers informed about shifting economic conditions and evolving foreign trade regulations worldwide. When we analyze the actual text and context of these institutional updates, a clear pattern of standard corporate administration emerges instead of an overnight windfall. To evaluate these claims properly, we must look at how commercial banks interact with the official monetary policies of developing nations. The underlying strength of any currency is determined by its central bank, not by the internal filing systems of foreign commercial entities. Sovereign nations manage their exchange rates based on macroeconomic health, gross domestic product metrics, and international reserve balances. Foreign commercial institutions simply act as processing conduits that must strictly adhere to the official rates established by those sovereign authorities. They do not possess the regulatory power to engineer or independently predict a dramatic shift in a nation's legal tender. When an internal update mentions a particular foreign currency, it is typically addressing transactional risk, liquidity limitations, or anti-money laundering compliant requirements. Misinterpreting these standard bureaucratic notices as a precursor to a massive financial reset is a fundamental error in financial literacy. Furthermore, we must address the specific structural developments currently taking place within the financial architecture of Iraq during this middle portion of 2026. The monetary authority in Baghdad has been consistently moving forward with an ambitious multi-year plan aimed at total digital modernization. This strategy is specifically designed to transition the domestic economy away from its historic reliance on physical cash transactions. Government ministries and private commercial sectors are actively integrating electronic payment platforms to enhance overall tracking and transparency. These digital systemic upgrades are vital for reducing domestic corruption and stabilizing the local market against illicit trading activities. However, these administrative adjustments are designed for long-term economic normalization rather than creating immediate explosive percentage spikes. Modernization is a slow structural process that requires years of steady implementation across various domestic institutional networks. When major international banks issue notices regarding these evolving transactional systems, they are preparing their platforms for new digital tracking standards. As foreign banking sectors upgrade their systems, international partners must adjust their digital communication lines to maintain compliance. This means updating software parameters, enhancing security filters, and ensuring all standard reporting requirements align with international guidelines. These adjustments ensure that cross-border trade transactions can be processed securely without triggering international non-compliance flags. Speculators frequently mischaracterize these routine software and reporting updates as an operational preparation for a massive currency revaluation. In reality, ensuring that transactional channels remain clear for standard commerce is a regular duty of global compliance departments. The actual focus is maintaining absolute transactional stability, which is the exact opposite of engineering a sudden, volatile market disruption. It is also critical to understand that the official exchange rate for the year 2026 has already been formally established. The monetary authority in Baghdad explicitly communicated to fiscal planners that the official rate would remain anchored at its long-standing baseline. This rate was deliberately chosen to provide maximum predictability for the national budget, public contracts, and oil export projections. When a central bank prioritizes absolute stability, it is signaling to global markets that it intends to avoid unexpected valuation shocks. Sudden massive fluctuations would severely disrupt budgetary planning, complicate international trade agreements, and endanger national fiscal health. Therefore, the official policy remains completely focused on maintaining continuity and protecting domestic purchasing power through controlled incremental progression. Online claims that suggest an imminent deviation from this official budget framework contradict the stated goals of the fiscal authorities. A major factor keeping these speculative rumors alive is the noticeable gap between official banking figures and parallel market rates. In local street markets, the cost to acquire foreign exchange often sits higher than the officially mandated government target. This divergence is primarily caused by domestic liquidity challenges, regional commercial demands, and strict rules governing official electronic transfers. When casual observers see these fluctuating parallel rates, they often mistake the local volatility for an incoming national revaluation. However, parallel market fluctuations merely reflect temporary supply and demand issues within unorganized local trading sectors. True currency appreciation requires a sustained increase in non-oil domestic production, rising foreign direct investment, and a fully diversified economic foundation. Speculating on short-term market spreads will not yield the permanent astronomical overnight returns promised by unverified internet personalities. We should also examine the immense logistical reality of attempting to liquidate exotic currencies outside of their native country. Many major commercial banking institutions do not maintain active retail operations for illiquid, non-freely convertible assets. If an investor walks into a standard local branch holding physical notes, they will encounter strict regulatory barriers. Financial institutions operate under stringent international guidelines regarding capital flows, source of funds documentation, and currency origin verification. Even if an asset experienced a nominal change in value, converting that physical paper into usable local funds is a highly complex process. Specialized dealers who choose to handle these assets typically impose massive transaction fees and strict volume limitations. This means that simply possessing physical paper does not guarantee an easy path to liquidating wealth in the global financial system. The psychological tactics used by promoters of these revaluation myths rely heavily on creating an intense fear of missing out. By claiming that a private notice has proven the reality of an upcoming change, they force individuals into a state of panic. This artificial urgency is designed to prevent rational research and push people toward buying more physical notes at inflated markups. True financial growth never requires navigating secret windows, hidden codes, or private institutional exchange tiers. Legitimate economic events are broadcast openly to the public through verified international media networks, official central bank portals, and global market terminals. If a sovereign nation permanently alters its monetary value, that data updates instantly across every digital financial system worldwide. There is absolutely no mechanism within modern banking that allows a secret wealth event to be restricted to private internet groups. To protect your capital and maintain a secure financial future, you must commit to anchoring your expectations in verifiable data. Regularly monitor the official press releases, statistical bulletins, and policy statements published directly by sovereign central banks. Look at measurable macroeconomic indicators such as real gross domestic product expansion, total foreign reserves, and domestic inflation trends. These real-world economic metrics are the actual drivers that influence long-term currency stability and organic appreciation. This factual progression moves on a timeline calculated in years and decades, not through sudden administrative resets over a weekend, but demanding cold, verifiable evidence and consulting with licensed independent financial advisors. You shield yourself from costly emotional mistakes. Thank you for tuning in to IQD Insider, your trusted source for calm, fact-based analysis that cuts directly through the online noise. Let us take a deeper look at the core structure of modern banking compliance to see why these internal institutional memos exist in the first place. Large international banks handle trillions of dollars in foreign exchange daily, and they must protect themselves from severe regulatory penalties by ensuring every single trade is fully accounted for and cleared through approved legal channels. Whenever a developing economy begins restructuring its local financial sectors, global financial institutions must send out comprehensive updates to their regional compliance departments to avoid any operational interruptions or international reporting failures. These specialized documents serve as educational guidelines for internal employees, detailing how to process routine international wire transfers, verify corporate documentation, and detect potential money laundering activities. They are designed to manage daily institutional operational risks, not to announce hidden monetary windfalls or notify the public about a secret currency wealth creation window. Another point to consider is the brand new leadership sweeping through the administrative corridors of the central bank in Baghdad this year. A career regulator and highly recognized anti-money laundering specialist has officially taken charge of the country's primary monetary authority, shifting the focus completely toward building deep transparency and establishing stronger international credibility. The strategic appointment explicitly highlights the government's strong commitment to satisfying complex global benchmarks, improving local banking supervision, and coordinating with international regulatory organizations to modernize the national economy. When a central bank prioritizes strict legal compliance and rigorous tracking of foreign asset flows, it is building a solid foundation for gradual, long-term economic stability. These institutional efforts are slow, deliberate, and highly structured, proving that the monetary authority is focused on steady operational health rather than engineering sudden volatile value spikes that would disrupt the local market. When you look closely at the international financial tracking frameworks, you realize that any country wishing to attract serious global investment must eliminate structural deficiencies within its financial systems. It is currently working diligently to fulfill these exact international benchmarks by tightening oversight on private banking firms, improving data transparency, and enforcing strict capital adequacy standards across all local Islamic and commercial banks. These regulatory upgrades require local institutions to significantly increase their paid-up capital foundations and implement advanced auditing practices over a multi-year transitional timeline. This massive institutional shift is designed to lift the nation out of global regulatory grey lists and restore full confidence among international correspondent banks. This essential process creates an incredibly secure environment for standard cross-border trade, but it is fundamentally an administrative marathon that moves incrementally rather than an overnight revaluation event. Many internet speculators frequently talk about terms like Tier 1 banks, historic bonds, or secret currency redemption centers to build an alternate reality. That sounds highly official to casual observers. They claim that certain large banks have established dedicated internal departments specifically to process immediate currency wealth transactions for retail investors under strict non-disclosure agreements. However, if you speak to any licensed financial advisor or experienced institutional bank manager operating outside these speculative groups, they will tell you that no such private systems exist. Modern banking networks require absolute public transparency, audited accounting sheets, and open reporting methods to maintain their corporate licenses and follow federal laws. A massive altering wealth redistribution event cannot be legally processed through hidden back-office tiers or secret countdown sequences because every major financial transaction must be thoroughly documented and visible to international regulators. We must also analyze the true economic drivers that actually cause a national currency to experience genuine sustainable appreciation over a long period. For a country heavily reliant on raw hydrocarbon exports, the overall strength of its local legal tender is tightly bound to global energy demand, domestic production capabilities, and national reserve balances. True organic monetary strength is achieved when a nation successfully diversifies its economy by building robust agricultural sectors, expanding local manufacturing, and generating consistent non-oil revenue streams. Furthermore, maintaining a stable domestic inflation rate and ensuring a peaceful, predictable political climate are vital components that encourage foreign corporations to invest long-term private capital into the country. These fundamental macroeconomic realities require decades of consistent governance and strategic infrastructure planning, which is the exact opposite of an instantaneous, unearned percentage leap over a holiday weekend. The widespread confusion surrounding these foreign currencies often deepens when central banks announce routine administrative procedures like a currency redenomination. A redenomination occurs when a government decides to update its physical currency by issuing a brand new series of banknotes that drop several zeros from the face of the bill purely to simplify daily accounting and everyday market transactions. For example, an old note worth 10,000 units might be exchanged for a brand new note worth 10 units. But the actual purchasing power and the international exchange rate remain exactly the same. Speculators frequently misinterpret these routine domestic currency updates, telling their followers that deleting the zeros means the value of their existing old notes will instantly skyrocket in the global market. In reality, this is merely a neutral administrative management process designed to make domestic commerce more efficient for local citizens. Let us look at what would realistically happen if a major sovereign nation were to officially change its exchange rate by a significant percentage. Such an immense economics event would immediately hit the front pages of every reputable global news agency, including Reuters, Bloomberg, and the Wall Street Journal, because it would instantly impact global trade lanes, corporate supply chains, and international market indices. It would be backed by formal public press conferences held by the central bank governor and international monetary bodies, providing clear instructions to businesses worldwide. Your personal mobile banking apps, international airport exchange kiosks, and public market trackers would all update their electronic data systems simultaneously in real time. The complete lack of any such credible, verified announcements across the global financial system is the most definitive proof that these private internet rumors are entirely fabricated. It is helpful to consider the sheer scale of the global financial system and why it naturally rejects sudden chaotic economic shocks like a massive overnight revaluation. Modern international commerce depends heavily on predictability, balance, and structured risk management to ensure that corporations can safely import and export goods across borders without facing sudden financial ruin. If a central bank were to engineer an unexpected multi-000% value leap, it would instantly destroy the country's export competitiveness by making its local products incredibly expensive for foreign buyers. It would also cause extreme domestic inflation, wipe out local business contracts, and create total panic within the global supply chains that rely on steady exchange rates. Central bankers are highly educated economists whose primary mandate is to maintain absolute market stability and gradual growth, making a chaotic wealth reset completely counterproductive. Furthermore, the ongoing digital banking revolution taking place in developing markets is focused on financial inclusion rather than immediate currency appreciation. Monetary authorities are heavily mandating that all government agencies, private businesses, and utility companies transition completely to electronic payment platforms by late 2026. This means expanding mobile wallet access, upgrading local internet infrastructure to support real-time point-of-sale terminals, and encouraging unbanked populations to open formal accounts. By bringing cash out of physical safes and into the digital banking system, the government can effectively monitor the domestic money supply, collect taxes, and combat illicit financial networks. While this digital transition drastically improves the long-term operational health and economic transparency of the nation, it is an administrative policy shift that takes years to bear fruit rather than an overnight wealth generation mechanism. When major international financial groups distribute internal messages regarding these foreign banking sectors, they are simply updating their corporate employees on shifting compliance rules. As developing countries adopt advanced tracking systems to monitor the flow of foreign banknotes, international correspondent banks must carefully adjust their internal software parameters and screening filters to stay aligned with these new rules. This involves updating compliance questionnaires, verifying the identities of international corporate clients, and ensuring all cross-border transactions pass rigorous anti-money laundering checks. Speculators who get their hands on these routine corporate update notices routinely twist the technical language to make it sound like a secret operational plan for an imminent revaluation. In reality, ensuring that global transactional channels remain clear and legally compliant is just a normal everyday task for corporate risk management teams. Investors must also think about the serious legal and logistical hurdles they would face if they attempted to exchange a large volume of physical exotic banknotes at a standard retail bank branch. Most local commercial banks do not keep physical stockpiles of non-freely convertible currencies because there is very little consumer demand for them in everyday domestic commerce. If an individual brings a significant amount of physical foreign notes to a bank teller, the institution is legally required by federal law to file comprehensive currency transaction reports and verify the legal origin of the funds. They will demand official receipts, corporate documentation, and proof of tax compliance before they can even consider processing the transaction. The process is incredibly slow, highly regulated, and filled with steep transaction fees, which completely disproves the idea of a simple, quick cash-out window. The persistent cycle of internet rumors often preys directly on the deep financial hopes and personal vulnerabilities of everyday individuals who are looking for a major economic breakthrough. Promoters of these schemes use sophisticated psychological techniques such as creating artificial scarcity and presenting complex-sounding economic terms to make their narratives appear highly credible to the untrained eye. They often bundle these theories with elaborate geopolitical stories about secret international treaties or global currency resets to explain away why the promised revaluation has been delayed for so many years. It is incredibly important to separate our natural desires for financial security from the cold, hard realities of international economics and central banking protocols. Real wealth is built over time through smart research, proper diversification, and fact-based strategies, not by chasing mythical countdown deadlines. We should also remember that many consumer protection bureaus and global financial regulators have issued explicit public warnings regarding speculative currency investments over the years. These regulatory watchdogs have repeatedly noted that buying low-value exotic notes based on internet rumors carries an incredibly high risk of permanent capital loss. In many instances, speculative currency brokers sell these physical notes to retail buyers at a massive markup compared to the actual official exchange rate, meaning the investor loses money the very moment the transaction is completed. These organizations strongly advise the public to avoid any investment opportunity that relies on high-pressure sales tactics, unverified inside information, or promises of guaranteed astronomical returns. Listening to these official regulatory warnings is a vital step in protecting your hard-earned savings from predatory online schemes. As we move forward through the remaining months of 2026, the smartest approach any currency holder can take is to become completely self-reliant by studying official unedited source materials. Instead of relying on anonymous forum posts or breathless social media videos, go directly to the official websites of sovereign central banks to read their actual policy statements, economic data bulletins, and legal directives. Track verified global economic indicators such as the country's total oil export volumes, the growth rate of its non-oil gross domestic product, and the size of its foreign currency reserves. These real-world data points will give you a clear, accurate picture of the nation's true fiscal health and its actual long-term currency trajectory. Cultivating a mindset of healthy skepticism and demanding verifiable proof will always be your greatest asset in navigating the complex world of personal finance. Thank you so much for tuning in to this extensive analysis on IQD Insider, where our mission is always to provide you with the calmest, most accurate, and fact-based commentary available. If you found this detailed breakdown helpful in cutting through the overwhelming online noise and protecting your financial clarity, please take a moment to give this video a thumbs up and subscribe to our channel. Share this content with your friends, family members, and fellow investors to help them distinguish between exciting online fiction and the actual operational realities of the global banking system. We are deeply committed to tracking the true macroeconomic data and bringing you the honest information that matters most for your financial journey. Stay grounded, keep learning, and remember that steady, researched financial strategies will always triumph over high-pressure rumors and overnight miracles. See you in our next deep dive analysis.